All right, let's go ahead and get started. So, today we're going to talk about getting started with options and discuss understanding options pricing. Now, the way that we set up this presentation is to really set those foundational elements that are necessary for understanding options. When you understand an options price and all of the factors that affect the way the anatomy of an option and just the movement of the option, it really lays the foundation for strategy selection, optimal environments, and even understanding the Greek. So it's a really great presentation that is so essential if you're starting out with options or if you're newer to options or even traded them before. It's a great reminder because the way that we structure this is that it really builds so you can understand even those advanced concepts. If you don't know me, I'm Jessica Inskip. I'm the Director of Education and Product here at Options Play. My job is to take anything complex and make sure that it's simple and easy to understand. And of course, before we get started, we do have to give you just a quick disclaimer. Know that there are securities and research tools that are going to be displayed. It's purely for demonstration purposes only, not considered a recommendation by Options Play or a solicitation to buy or sell securities. This video is not intended to be tax, legal, or investment planning advice. Additionally, options have risk. They're not suitable for everyone. There are certain requirements that have to be met before you can even trade options. There's a document called the ODD, which goes over those characteristics and risks of standardized options that you should absolutely review before considering any options transaction. And of course, the risks that are exposed with this options Play is also a third party not affiliated with First Trade. So therefore, anything we say has nothing to do with First Trade. Important to know there. Without further ado, and of course, giving you all of those legal disclaimers, let's dive into what we're going to discuss today. So, first, we're going to go over an anatomy of an option, what comprises an option. We'll talk about calls versus puts, the options premiums, and the meat of today's presentation. We'll talk about intrinsic and extrinsic value. Make sure we'll define that because it all relates to the options premium. Go through some examples and of course save some time for Q&A at the end. So let's go ahead and get started. What exactly is an option? Well, an option is simply a contract between a buyer and a seller. The buyer pays a premium for that contract, and the seller receives the premium for that contract. The contract has some terms associated with it. So in this example, we've got a contract that represents 100 shares of ABC at $100 per share, and it's executable at any time until this expiration date of May 20th, 2022. So let's assume that's 30 days from now or whatever time frame. If I'm buying that contract, I pay for that contract, which means I own the right to execute upon that contract at any time. So I want it to have as much value as possible because I can utilize the terms of that contract and either buy or sell stock at that predetermined price. The seller, on the other hand, receives that premium or that what the buyer paid upfront. That's called a credit. And they are in the opposite end of that. They do not want the option to have any value whatsoever. In fact, they want it to expire worthless. That is going to be their max gain scenario. And we'll talk about that in a little more detail. But what I want you to take away from this is if I'm a buyer, I can execute upon the terms of that contract, which means I own the rights that that contract contains. If I'm a seller, I'm obligated to fulfill the other side, which all is just a fancy way of saying if I'm a buyer, I want it to have as much value as possible. If I'm a seller, I don't want it to have any value. I want it to diminish in value. And the difference of a call or a put, that's just the way that the contract is issued. A call just means that it contains the right to buy, and a put means that it contains the right to sell. So in this example, if this contract were issued as a call, the buyer would pay a premium for this call contract. Since it's a call, it would represent the right to buy 100 shares of ABC at $100 per share at any time through that expiration period. So the buyer, since they want it to have as much value as possible, they'd want ABC, since ABC could go to an infinite amount, go as high as possible. If ABC's at $150, I've got an executable right to buy 100 shares of ABC at $100 per share. So that's what I mean. I go up in value as much as possible because it should have a value associated with it because I have the right to buy or sell at a predetermined price. And then the seller, since they would be obligated to fulfill the other side. So in the case of a call, since the buyer has the right to purchase the shares, the seller, someone's got to sell it to them at that price. So that's what the seller does, is they are obligated to fulfill the other side of the contract. An analogy that's used quite often is a house. If you have written up a contract about a house where you are agreeing to a price, you, the seller, have to sell that house at that price regardless of what happens during that time frame, because you made a binding contract and the buyer is obligated to execute upon that. There's, of course, other things with it, but if it sounds like there is a lot of legal jargon and it sounds like this legal binding contract, that's because that's exactly what it is. It is a contract between a buyer and a seller. The buyer can execute upon that contract. The seller is obligated to fulfill the terms. The buyer receives, or the buyer pays a debit, so pays the premium, and then the seller receives a credit and receives the premium. And of course, we're going to go through that one more time, but like to just start with, this is what an option is in its most basic form. So let's talk about the anatomy of an option. Just like we have any type of contract, this is what comprises the terms of that contract. We always ask, what quantity are we agreeing on? What product are we agreeing on? What price and what time frame? Now, these are all questions that we are going to answer that are contained within the legal terms of that contract. The quantity is simply the contract amount. So how many contracts do I have? One contract generally represents 100 shares. That's important to know. So if I say I have one call contract where I can buy ABC at $100 per share, that means I can buy 100 shares of ABC at $100 per share, because one contract always represents a round lot or 100 shares. The product is just the underlying security. We were saying ABC, but ABC could be a stock, an ETP, which is an exchange traded product, index currency, or even commodity. Not a full list, but lots of products that you can write an option contract on. The price, that's simply the strike price. So that is also known as the agreed upon price, and that's priced per share. So that's when we're always talking about one contract with a strike price of 100, that means 100 shares at $100 each. And then the time frame is just simply the expiration date. Now, it's normally on Fridays. And interestingly enough, with all of the changes that are happening with options or just access to technology, options used to only expire monthly, then it moved to weekly. Now we have products that expire daily. So it's just certainly really interesting how many options in that world is transforming. So in example form, we'd have one ABC 100, and we'll just assume July 29th is 30 days from now. This represents 100 shares of ABC, the underlying security, at a strike price to the agreed upon price of $100 per share. And this is our time frame. It's then issued as a call or a put. And like we said before, the call just simply means it contains the right to buy. And then the put means that it contains the right to sell. It can be exercised, which means you execute upon the terms of that contract. So if I was the call owner, I purchased this call contract, I would have, in order to exercise or execute upon the terms of the contract, I would buy 100 shares of ABC at $100 per share prior to this expiration date. And I do have to apologize. These should say the same thing. So do not let that confuse you. The put is just the opposite. That just means if I were to execute upon the terms of that contract, I would sell 100 shares of ABC stock at $100 per share. That's exercising. You own that right when you purchase the call contract or the put contract. However, you are the driver of that situation. You do not have to execute upon the terms of that contract if you do not want to. And that all goes into options pricing, which we'll talk about in a moment. The option can also expire. So once your expiration date is reached, this is where it really differs from a stock. A stock, theoretically, you can hold forever. An option is going to cease to exist once that expiration date has come to fruition. You no longer have that right because that right was only good for a time frame. And so that's important to know as we go through this options pricing and understand how a premium is comprised. And then last and certainly not least is traded. You can trade that option on the secondary market. So when we are buying the call, the way you'd enter that order, we would buy the call to open. You would pay a premium for that when you're trading it on the market through your order ticket. You can also sell the call to close. So you just do the opposite transaction. And you do that on the secondary market for a price. That's trading the option. And that price is referred to as the premium, which we'll talk about how that's comprised and what makes up an options premium, which is extremely important to know when you dive into the world of options. Now, if you have never heard of options before, this is your first time looking at it, I'd love to introduce the T-chart. We build this out throughout options play, and we even add the Greeks layer on top of this. So this is your key to understanding calls versus puts, and we build on this throughout an entire series. So it starts with a T. We have calls on the left and puts on the right. Put long calls on the upper left-hand quadrant and short calls on the bottom. So all calls on the left-hand side. And then we do the opposite for the puts. Put the long put on the bottom right-hand quadrant and the short put on the upper right hand. Now, what you'll notice is there's some color coding going on, and that is because anything at the bottom is bearish and anything at the top is bullish. So when we're teaching options and you're learning about options for the first time, focus on long calls and understand long calls. And that's why we show you this T-chart, because if you understand how a long call works inside and out, then you can utilize this to understand everything else out and put that options pricing puzzle together, or the options puzzle together, really. So some terms and some tips and tricks that I want you to keep in your mind. Anytime you hear the word long, I want you to think of buying or purchasing. I purchased. If you hear the word call, that is the right to buy. If you hear short, that means sold. And if you hear put, it's the right to sell. The right to in front of either one of those is extremely important. Why is that? Well, if I say, okay, I have a long call, that means I purchased the right to buy. Since I purchased the right to buy, I own that right. I purchased it, so it's for a premium, which means I want the value of that option to go up as much as possible. That's why it's on the bullish side, because if I can buy at $100, ABC at $150 is really, really valuable. $160 even more valuable. The opposite is true for the short call. So if I'm short, I sold the right to buy, which means since I sold it, I received a premium, and I'm also obligated to fulfill the other side, which is meaning if they execute upon their terms and want to buy at $100 per share, I just sell it to them at $100 per share. If that contract starts having value, executable value, where ABC is at $100 and then ABC is at $150, well, if I can execute upon my terms at $100 and then the market's at $150, if I don't own the underlying security, this could be a really unlimited loss situation. So in order for me to be profitable, I want ABC to go down in this scenario because I do not want them to be able to execute it. And then the same is true on the other side. I don't want to go in too much detail of this T-chart because we're actually going to do that on the next session where we really dive into long calls and long puts and you understand them. But for today's session, I want you to focus on a long call where we've purchased the right to buy, which means we are bullish when you are purchasing an option, really great analogy I like to use is a driver and a passenger. So if you're in a car and you're in the driver's seat, you are the one that's choosing to go left and right, stop at the stop sign. You're making the decisions, and then you are executing upon those decisions if you choose. The short call holder, they're the passenger. They are obligated to go right or left because they're strapped into that car, but they can kind of get an idea of where you're going to go. They're not going to execute upon it, but they can have an idea by paying attention to their surroundings. So it's important to pay attention to your surroundings. And that's really what we're focusing on today, is that options price is your surroundings. Does it make sense to go left or right? Which is an analogy for, does it make sense to execute these options contracts? And in order to understand if it makes sense to execute upon the terms of that contract, we have to understand how an option is priced. So let's go into that pricing mechanics. So we know that we call that a premium, and a premium is comprised of two components. The first is intrinsic value. The second is extrinsic value. Now, intrinsic value, we've actually talked about quite a bit leading into this. We also call that in the money, which just means that it has executable value. So, for example, if we have a long call and the underlying security moves above my strike price, well, if I have the right to buy at 100 and this is 110, 130, 140, 150, that's going to continue to have executable value, which is another word for intrinsic value or in the money value. It is in the money, which means it can be executed upon. The strike price is more favorable than the market price. That's what that means. Now, extrinsic value is made up of two primary components. One is time value. So remember, options have an expiration date. The more time you have until expiration, the more expensive the option's going to be. And that makes sense because it has more time to have executable value. An option that expires 1 week from now is going to be less valuable than an option that expires 1 month from now. Now, we can only move one direction within time unless you have some other type of mechanism, in which case I would love to know. Therefore, that's something that's going to decay and move against us. And that's important to know. When we purchase that option, time value is going to deplete because there's going to constantly be less time left for that option to have executable value, if any, prior to expiration or at expiration. And then the third pricing component, second of extrinsic, is called implied volatility. Now, the textbook definition of this is the market's forecast of a likely movement in the security's price. Really great example of that is an anticipated earnings announcement. If we are in earnings, there is an analyst expectation, and we are waiting for the security to tell us if it's going to meet or miss analyst expectations. But we know if it meets or misses, inclusive of revenue, that corporate event, that it's going to move a lot in either direction. And because it's going to move a lot in either direction, that means it has a higher likelihood of having value, which means it has an inflated price. So something to be careful of if you're trading options around earnings because of that third component. Also, something that happens, and we won't talk about it too much on today's presentation, after that anticipated earnings announcement. So we're waiting and waiting on the securities earnings announcement. Because we're waiting on the earnings announcement, implied volatility is really high, which makes our options premium more expensive. But as soon as that announcement happens, it contracts, and we call that volatility crush because there is no more likelihood movement of the underlying security. The event that we were anticipating already happened. So that's all I'm going to go to in implied volatility today. And for the rest of today's session, we'll talk about time value and in the money value. So those are two important to know. Now, the way that I like to remember this in my mind is intrinsic value is really just internal factors that affect the options price. The internal component is the underlying security. So does the option contract have any value or not? As in, does it have any executable value? Can I exercise my right to buy? And is that right to buy better than how in a case of a call, less than what the market is pricing. If so, then it has in the money value. And then extrinsic value is really external factors that affect the options price, things outside of our control, like time value and implied volatility. So let's build on that example. We're going to stick with ABC Incorporated stock, and let's say it's at $103 per share. And we've got an option. It's a strike price of $100. It's 30 days left until expiration. It's issued as a call, and that premium or the last price of that option is $5 per share. So remember that this represents 100 shares of ABC at $100 per share for a 30-day period. And I have the right to buy 100 shares of ABC at $100 per share. And for that right, I paid $5 per share. So let's break down what that premium is made up of. So we know it's intrinsic value and extrinsic value. Well, if we have the right to buy at $100 per share, and ABC is at $103 per share, well, our right to buy is a much more favorable price than the market price of 103. So that has to be worth the difference, which is $3 per share. That's the executable value. And then your extrinsic value is just anything in excess. So our premium that this option is traded at, or the price of this option, is $5 per share. The in the money value or executable value is $3 because right to buy at 100, sell at 103, the difference of those two. So therefore, my extrinsic value is $2 per share. What's important to know is this will go up in value if ABC goes up in value. This will move based on its internal factor, which is ABC. This is mainly time value, so this will move and decay even if ABC stays exactly the same. And that's important to know. And we'll dive a little more deeper into that. So let's drive home intrinsic value. ABC is now at $105 per share. And let's look at a 95 strike call that has 30 days left until expiration, and it's trading at $12. Well, the intrinsic value of that's $10. Makes sense. I can execute my right to buy at 95 and immediately sell at the market at 105. So the difference of those two is $10 per share. The extrinsic value is just the difference, so $2. Let's look at $100 per share. This last price, or the premium, is at $8. So therefore, the intrinsic value is $5. Right to buy at 100, sell at 105. Difference of those two is 5. And then the excess, $3, is the extrinsic value. Let's look at $5 higher strike price. So 105, premium is 5. The intrinsic value, there's 0. We have actually an at the money option here. New term for you. So these are in the money because they have executable value. This is at the money because it has the same value as the market. So it has 0 intrinsic value. It's not favorable. It's equal to exercise these rights versus the market. But that means the entire premium is made up of extrinsic value. So that time value and implied volatility component. If we go up another $3 in this case, we've got a strike at 108. So we have the right to buy at 108, but the market's at 105. Hopefully you saw that there should be no intrinsic value and that entire premium is made up of extrinsic value. Now, all of these options do have one thing in common besides the underlying security, and that is they have 30 days left until expiration. Now, what you might have noticed is that this isn't necessarily linear, meaning this extrinsic value component, which is the one that's working against you, it's not equal as we move down in $5 increments. That's because it's actually centered around these near the money options or at the money options. And that actually is a implied volatility component and a theta component. Therefore, that's just what I want you to take note of. And that's because time value isn't linear, but we'll talk about that in a moment. Nonetheless, that's your takeaway. And what I need you to understand from this is intrinsic value difference of the strike price and the last price of the security. Extrinsic value is anything in excess of that premium. If there is zero executable value, then the entire options premium is made up of extrinsic value, which is the external factors that we cannot control. All right, and moving on, this is a real example that's just been masked that I like to show because it gives a good indication of what we just discussed. So this is ABC, again, real security, just changed it to ABC. So we've got an in the money option, an at the money option, and an out of the money option. All of these are about 30 days left until expiration when this screenshot was taken. And what I want to show you is this in the money option. So it's 150. So if I have the right to buy at 150 and this security is at 157.73, then that means the intrinsic value is $7.73. The excess of that premium is $3.27. So that entire mouse is very sensitive. Apologize. That entire premium has intrinsic and extrinsic value, most of which is that intrinsic value. This at the money option, that's the closest we could get as 160. The entire premium is now extrinsic value, and then the out of the money is also extrinsic value. So the right to buy at 165 or 160 is less favorable than this ABC price. And what I want you to hopefully make an observation of is that how high is that extrinsic value component when it's near the price of the underlying security, or really far away from the price, or already has some executable value. And it's normally the highest around at the money options. And this is a real life example of that scenario. So moving on back to ABC stock and easy math with 105 a share. Let's look at ABC 100 strike call that has 0 days left until expiration with a premium of $5 per share. The intrinsic value is $5 per share. Because we have the right to buy at $100, can immediately sell at the market at 105, has to be worth 5. 0 extrinsic value within this option. And that makes sense because there are 0 days left until expiration. This option has reached its life. Therefore, it is not worth any more time value. That is completely decayed. The only thing that option is worth on expiration is its executable value. And that tends to change also even rapidly throughout the day. Let's look at 30 days left until expiration, same strike call. This one is $8 a share. Well, we've got intrinsic value, still the same, $5 because it's the same strike price. Now, just the excess is the extrinsic value, which is $3. And we've given ourselves another 30 days. So it makes sense that there is some extrinsic value component to this options premium. Let's look at 45 days until expiration. So now we're going out 15 days, same strike price, and the premium is $1 more. So intrinsic value remains the same. Our extrinsic value is now $4. And let's move it out to 60 days until expiration. So another 45 days. The premium's $9.50. Strike price remains the same at 100, which means intrinsic value is $5 per share. And that excess extrinsic value is $4.50. Now, hopefully you made another observation here. First is this all had the same intrinsic value, which makes sense because they all have the same strike price. They all contain the right to buy 100 shares of ABC, different time frames though. And because they have different time frames, we have different extrinsic value. And what you might have noticed is that the time value component does not move in equal units. We had 60 days until expiration. And the time value or extrinsic value component is $4.50. We lost a whole lot of time and got to $4. So we only lost 50 cents here. Move more time, Only $3. So there is a larger width here than here and here. And what you should notice is time value, or that time decay component, is not linear. It actually depletes really quickly and accelerates the closer we get until expiration. So we had 60 days to 45 days, we only lost 50 cents. 45 days to 30 days, we lost an entire dollar. And then that last 30 days, rapid decay. And that's important to know, because when we're purchasing an option, and remember, we want it to go up in value as much as possible. And that happens when the underlying security moves in our favor. So in this case, all of these examples are long calls. That means go up in value. So this is something to be cognizant of, is this is going to move based on this underlying security moving. This, on the other hand, the extrinsic value component, is something that will move against us as options purchasers. And that's why it's important to have an exit strategy. Some topics we will discuss next on the next session. But essentially, that's why options are traded on the secondary market. It may not make sense for you to execute upon the terms of your contract here because you'd give up this. If you execute upon the terms, that just means you buy at $100 per share and sell at the market at 105. So you still get that $5 difference, multiply it times 100, but you're going to give up $3 worth of extrinsic value. So that's why if the option or the underlying security moves in your desired direction, oftentimes they're sold to close or closed out on the secondary market because of that extrinsic value component. This is something that you purchase as an options buyer. You purchase time value, but that also means that you can sell to close times value before this rapid decay kicks in, and something we talk about a lot in options play. All right, so let's look at another real example of this ABC security. So now when this screenshot was taken, it was not the day of expiration, but we had 2 days left. So we've got a slight amount of extrinsic value there. But we have the same strike call, so 150 across the board. We've got 2 days until expiration, 30 days until expiration, and 45 days until expiration. All of these, since they represent the right to buy at 150 and the underlying securities at 158, have an intrinsic value of $8 per share. That is constant and consistent. However, this $2, or the 2 days until expiration, only has 20 cents of time value or extrinsic value, 30 days, $2.95, and then 45, $4.70. And hopefully you see the rapid decay. There's 15 days in between here. It dropped from $4.70 to $2.95. Whereas on the other hand, there's 18 here, and we dropped from, there are 28 there, and we dropped from $2.95 to 20 cents per share. So that's that rapid time decay that we're talking about. It normally happens at 14 to 21 days until expiration. All right, so let's look at another example with our handy dandy ABC. So ABC is at 105 per share. We placed a trade and we purchased one ABC 100 strike call with 30 days left until expiration, and that premium cost us $6 per share. So we spent $600 total. Our strike price is 100. That means that this premium has $5 worth of intrinsic value, $1 of extrinsic value. And we have this duration of this contract is good until expiration. Now let's go to expiration and see what happens. On expiration, say it was at $110 per share. That means that the options value is $10 because we have the right to buy at 100, can immediately sell at the market at 110, has to be worth at least $10. That entire options premium is worth the $10 of intrinsic or executable value. That equals a gain of $4 per share, or 400 total. Because remember, we paid for this. This is a decaying factor. We did not get that back. However, it moved more than the extrinsic value that we paid for the option. That's what's important to know. Let's see what happened if ABC was at $105 per share. So it didn't move very much. And we get to expiration day and it is at the same price at which we placed that trade. Now that means our premium is only worth the $5, the intrinsic value, and that entire extrinsic value that we paid for has decayed, which would equate to a loss in this case. We have a loss of $1 per share or $100 total. Now, let's say we were completely wrong and ABC went down to $95 per share. So it moved down $10. The options value is zero because we have the right to buy at $100 per share, but the market's at 95. It doesn't have any executable value. It's more advantageous to purchase on the market than what the terms of this contract contains. In this case, at expiration day, we'd recognize full loss of the amount that we paid, $6 per share. And what's important to know here, and the key takeaway of taking you through this example, and hopefully that tied everything together, is this component here as an options buyer is something that works against me. It's made up of time value and implied volatility. And all of these examples, we looked at holding an option until expiration. And when you hold an option till expiration, that means this will completely deplete, completely gone, because your option is only worth its executable value on expiration. And that's why price targets and an exit strategy are extremely important when trading options. And of course, your options intrinsic value, that's not the only component that makes up an options price. An options price is comprised of an internal factor, which is it's a derivative. So it derives from the underlying security. So in this example, ABC. But unlike a stock, it has an expiration date, and therefore that influences the price of the option. So hopefully that gave you a clear or at least better understanding of how an option is priced. On the next session, we are going to go into more details and explain long calls and long puts. So I will go ahead and take any questions if you have any. Otherwise, appreciate you taking the time today to understand options and invest in your education. And I will give it a minute or two for questions. I know sometimes it takes a little bit to type them out. All right, I see a couple in there. Hello. 0 days until expiration. Is that only on Fridays? No, it is not. There are options that expire every single day. Namely, it is more actively traded options have more expiration periods, but there are so many. And you can see that on an option chain. So on First Trade's platform, type in an underlying security, pull the option chain, and option is sorted by the expiration periods. We're going to stay away from four-legged options questions on this platform, but on your return on investment, it is capital set aside for that type of scenario versus gain or loss. Justin asks, what do I think is better, SPX or SPY options, and why? So know that it is a personal preference and this is a self-directed platform. So what I'm about to say is my personal opinion, not First Trade. So I'll give you that disclosure. But there are some pros and cons for either one of those. SPX options, that is an index options, which means that it's not settled by the underlying security. It's purely by cash. When you have a equity or ETF like SPY, the stock or the underlying security changes hands. So when I am buying the call and I have the right to buy 100 shares of SPY at whatever price, if I execute upon that or it's in the money and I get auto exercise subsequently assigned, you could end up owning or shorting those shares because shares are exchanged. Whereas if you have SPX options, it's just a credit or a debit because they're settled in cash, which is way more advanced than what we just talked about. But we do have a whole session on index options and the difference of them that we can absolutely go through. But SPX is easier because of the cash settlement. They normally can only be exercised on their expiration day within a short period. So they're actively traded. Both of those have quite a lot of volume. And then there's actually taxation differences with index options versus equity options. You can look at irs.gov website to go through that, but if it only matters if you hold it at the end of the year. So it is a personal preference depending on your risk tolerance and also how they're settled as well. So that's why it requires a whole presentation to go through the difference of ETFs versus index options, because some look at are AM settled, others are PM settled. A lot that goes on there. What capital would be reserved for a short option trade? That really depends on your options level and your account. There are rules that you are welcome to look up that go through the margin rules on the FINRA website that will tell you the exact margin requirements, can give you the general. If you are short a call, that is considered a naked option that normally has the highest requirement, could even be higher if you're concentrated because he has unlimited loss potential. Otherwise, it's covered by the underlying shares. A short put would be the cash equivalent of the executable value, or in the case of a naked option, a normally about 25%, but then could even be higher. So all the way up to 100% of the executable value. And then for spreads, usually it's the difference of the two. And that's a credit spread. But again, that is something that is very specific to your account because it also goes into concentration, and margin is a very complex set of rules and regulations. All right. Looks like we answered most of those questions. Thank you for putting those in. If you guys have any other topics that you want us to cover, make sure you contact First Trade and let them know. We want to make sure that these are insightful and as useful as possible. With those index option questions, perhaps we'll add that to the roster where we'll talk about index options and the difference of index versus ETF or equity options, because there certainly are lots of differences. But know that today's session was largely a beginner session. Hope you found some value from it. Thank you again. And I hope everyone has a wonderful day.